And to look more closely at the commodities sector, I'm joined by Jonathan Barrett, Managing Director with Commodity Broking Services. So, Jonathan Barrett, welcome to the program.
Good morning, Whitney.
All right, so looking first at gold, it's come off its 3-week highs. Is that just profit takers covering cash positions?
I think it is. I think it's just a little bit of profit taking going. Gold has had a terrific run, and I think that just this news about what's happening in Europe has seen a bit of dollar strength. So, if anything, it's more to do with dollar strength at the moment as people move to the dollar in face of this uncertainty.
Silver has also declined. Is that to be expected given that it's been rising about 31% over the last 12 months?
It is. I mean, silver, in my mind, is one of those industrial metals as well. It is a little bit different to gold, where a high proportion of the metal is actually used in the industrial processes. So naturally, when you start to get a bit of a shock to the system, things aren't as good as what we thought they would be, then naturally you'd see silver come under a little bit more pressure than gold.
Okay, so if we then look at the US dollar, if it continues to be a safe haven, will that then continue to weigh on precious metals?
I think it will to a certain extent, but not overall. I think particularly gold, in my mind, will remain relatively well bid, or it won't have as sharp a fall as some of the others. And that's purely because we've still got those inflationary concerns that we're feeling sort of in Europe, in the UK. And that to me is sort of going to underpin, I think, any fall in the price of gold. So I think if anything will come into support for gold, if in fact it does come a little bit lower.
We are nearly at the end of October, going into November, seeing the end of the year, though. Many were, predicting that we would hit $2,000 an ounce by the end of the year. That looks quite a long way off now.
It certainly does, there's no doubt about it, but we are still seeing a lot of physical demand for the metal, and this is what we're seeing particularly out of Hong Kong, particularly out of China, and even in Sydney, where we're seeing a lot of the local buyers still seeing a lot of demand. So that will eventually filter down to the markets. So we're not going to see 2,000 perhaps this side of Christmas, but I think the market, and I think we're certainly relatively confident that gold will reach that 2,000 sometime through next year.
All right, let's move on to oil. Now, it's fallen off the back of those continued murmurings out of Europe. This is a switch from last week, though, because last week when we spoke, we had this plan with no plan, no details released,
correct.
And yet oil had risen. Now, what's the deal here?
Well, it's quite interesting because oil is trading with the equity markets, and that's where we're at. If equities go down, oil will go down. It's funny because it sort of seems to be that commodity which is just in tune with the equity markets.
So it's lockstep with equities?
Basically, yeah. So if you're going to get any negative news in equities, oil's going to come under pressure. Positive, oil's going to trade high. Oil, however, has set a range, and I think the top end of that range is 88, and the bottom end at the moment is 85, then 80.
Can you just explain, though, because we're also, we've got increased petrol prices at the bowser, I think up 6 cents in Australia or Sydney. When we see a drop in oil, we see rising petrol prices. Why is that?
Look, I think this is one of the things which...
Because it's a great, issue of debate.
It always is. I think one of the things that people don't realise is that 70 to 75% of Australian oil is actually imported. So we have that concern whenever the international prices do move, we move. But we've got that problem because we have to buy in Aussie dollars. So you've got that other variance in there, just the price of oil, but also the price of the Aussie dollar. So when that moves adversely, i.e. that it weakens, which is bad for imports, prices for the oil remain high. Prices for the petrol remain high as well.
Okay, well, I'm glad you've explained that because I think there are a few people out there that will be very interested in that. If we can now just turn to China, GDP figures will be out about 12 p.m. Australian Eastern Standard Time today. Depending on the number, what impact will that have on the commodities sector?
I think the market's looking at China as a whole group of numbers. We had CPI and PPI last week, GDP, industrial production today, so we're going to be focused on what's actually happening. Now, the numbers aren't going to be that good, but it'll be in line with expectations, and I think that's what people have to realise. When you look at growth where it is 9%, 8.5%, if you see it just starting to trim back a little bit, that's lock and step with policy that the Chinese authorities want. So it's not an overall negative picture. It should actually be seen as, yes, the policy's working, the economy is slowing, but it's slowing because we want to pull back inflation.
All right, but there are analysts out there that have been hawkish on, China for a while. Yeah. So what's the potential for downside risk if it does drop below what we're expecting? Because we always know that let's face it, the numbers out of China can be rubbery.
They can, but this is all part of policy. There are a lot of concerns out there of a contagion, particularly in the real estate sector, and that's going to have a big weight factor on demand. That's all good, but when you really look at the demand for commodities, it's still there, and all we're looking for is just a pullback in consumption and demand. These numbers and the CPI numbers that we had all show that if there is a slowness in the economy, it's happening to policy, and I think this should be rewarded.
All right, let's also this story with Rio Tinto, if we move on there, expecting demand to be sustained despite, moderation in growth. Is that just sugarcoating a negative story?
Look, I think it is. I think it's more about retiring a little bit of debt. Remember, they do have quite a lot of debt on their books, and it's also, in my mind, setting them more of a scene for the future, where they want to shore up their balance sheet amidst uncertain economic times. So I think it's more of a strategy, but I think it'll bode well for Rio going forward.
So you don't think that the selling off of these assets signals something much deeper, systemically wrong? No,
not at all. I think that the assets were performing, but not performing as well as the others. It just gives Rio that opportunity to focus on what it's really good at. The hard thing about aluminium is that it's an energy consumer. It's very intense in terms of the energy it consumes, and you really need to good strong prices. The prices for aluminium haven't been as strong as the other base metals, so in my mind it just seems like a natural thing. Move away from that and focus on what you can do.
Jonathan Barrett, thanks for joining us.
Thanks, Whitney.